Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Japanese long-end yields jump after weak demand in a 40-year bond auction reflects ongoing concern about global fiscal sustainability. Investors look for clues on the future of AI demand and the impact of chip export controls when Nvidia reports later today. Plus, Ukraine's president heads to Berlin after the German chancellor backs Kyiv's military strategy, while President Trump says Vladimir Putin is, quote, playing with fire.
A quick check on these markets here. Weakness across the board, perhaps not the sell-off that maybe we were due, given the optimism we've seen baked in on this side of the Atlantic. Your Stoxx 50 futures down only 0.3%. FTSE 100 virtually unchanged. We'll see how that shakes out at the open. Several micro stories we want to keep our eye on. At the same time, weakness in Eurodollar. Risk sentiment is lower on both sides of the Atlantic, and the dollar is stronger. We haven't seen that combination in some time. However, the dollar is weaker against the Japanese yen. The bond market story there factoring into the FX piece. The countdown to the opening trade starts right now.
Wednesday morning, good morning. So I spent the morning thinking about left-hand side tail risk and the kind of the things you normally see during a paradigm shift. Who would have had the Japanese 40-year on their agenda as being something they needed to think about 3 months ago, 6 months ago? And here we are this morning with that long-end bond that we've rarely talked about ever. I can't remember a time in my career, and my career is quite long, focusing on this, Anna. And here we are, the Japanese bond market.
Yeah.
Who'd have thought it? Long duration Japanese bonds, largely owned by the BOJ. And this is the epicenter of the action this morning.
Yeah, low volume and high volatility seems to be a feature of this market in a way that perhaps some people didn't see coming. But if yesterday's story was a story of contagion into the wider global bond market, I suppose the good news, the line in the sand news, is that today's move is not having quite such an impact into other global markets. It's certainly not having such an impact into treasuries. We're only on the 30-year treasury yield, we're up by 2 basis points. But just to backtrack, you know, we are showing you Japanese bonds here. We're up by 4-5 basis points when it comes to the moves in yields at the 20-year horizon, the 10-year horizon I was quoting there, the longer end up 4 or 3 basis points. So we are seeing this move higher on the back of a disappointing 40-year auction, as you cite there, Guy, the weakest in around a year. Now, Governor Ueda saying they're watching the impact of the super long bonds on the short end, because it's the short end that the central bankers often focus on themselves, as that has a big impact on the real economy, and that gives the market a sense that perhaps there is some change coming in terms of the issuance structure. All of these things seem to be on the table.
Is there a believability question here that they won't change the issuance structure? Because yesterday we saw the opposite. We saw such a bid into the long end of the bond market, specifically because we thought that issuance change was coming. So to see the opposite, I'm not really sure how to interpret it. Do you interpret it as those fiscal deficit concerns, which are absolutely on every part of the market, on every corner of the world? Or do you say, well, actually, maybe the BOJ won't change tact, and therefore that bid that you want onto the 40-year won't be as strong?
So I don't know. And that's the problem here, is that we normally spend hours and hours kind of going over the finest details of the bits of the market that we're focused on and we understand, like Nvidia numbers later on. We've got a pretty good idea of kind of how Nvidia plugs into the global economy and the things that we need to focus on. The Japanese 40-year, I have no idea about. I have no idea about the interconnections that are going to be formed as a result of what is happening at the long end of the Japanese bond market. And that's the bit that I think is really interesting, is that we're not in uncharted territory, but we're in rarely charted territory. And that's the challenge for markets at the moment.
It's fascinating, though, because Japan has always been a little bit of a guinea pig for the United States. So if we're talking about this is a little bit of a different story, but if we're talking about these same deficit concerns in Japan as we are in the United States, we're talking about this haven-like currency, the dollar and the yen, kind of perhaps losing that appeal. Is this a test run? Like, is Scott Bessent watching this and saying, let's see how this goes, and then maybe adjust our U.S. issuance story?
I mean, there's talk of fiscal concerns in both geographies, but the performance of the currencies is quite different, isn't it? And yes, so as you say, maybe Scott Bessent watching that with interest. Now, what we don't understand about the 40-year in Japan, we have people at Bloomberg who do. That's the beauty of working with such a large, financially focused global media empire, is that we found somebody who does, and we'll be talking to them later in the programme.
Absolutely, picking their brain. But Guy mentioned Nvidia, and I think that's a much more clear read-through that we can have in these these markets. But I think it's a little bit of a scare factor here because Nvidia, on the one hand, we talk about this every quarter. They're the A++ student. Every quarter, we're like, are they going to live up to expectations? There's lofty expectations. This time, I think it's the geopolitics, the tariffs, and the kind of AI story that mesh together. Suddenly, the export controls are something you can quantify, so you can see what that bottom line hit is. They've already given some numbers, but given this kind of tariff truce that we're on, does that narrative change?
I was interested to read some of the analyst comments this morning suggesting that they don't think the whole analyst community has taken on board the impact of the ban on selling H20s into China. So that kind of seems like old news because they created this H20 to sell into China, which was itself a replacement for the H800 that the Biden administration stopped them selling into China. You would have thought that the analyst community were on board with this, but it does seem as if that's not yet fully priced in. I suppose that could be an area where we look for more clarity today.
And still constrained on Blackwell. Like they can't do everything they want to do with their most cutting-edge technology. There is clearly still a great deal of demand for that, though I will still be interested to hear what they have to say about the AI build-out and what is happening there and how much demand there still is. We know they're supply constrained. Is demand beginning to come in a little bit?
And it was interesting, Morgan Stanley making the point that the two aren't necessarily linked. So just because you're not producing quite so many H20s for China doesn't mean you produce more Blackwell-powered chips for the US data center market, which, of course, will be the other area of focus for us.
The other thing to keep in mind is Nvidia's just been touted as investing across the world, in the Middle East, in Asia, a lot driven by the Trump administration. Do we get some concrete numbers about what the Trump administration is promising on behalf of Nvidia and the chip community and what Nvidia is actually putting to work there? That's the math I'm curious to see.
There's been this kind of big lump, which is kind of AI, and everybody's benefited from that. Are we starting to see separation, titration within that space? Who is succeeding, who's not? It's interesting, we're starting to see failures in the space. Are Google and OpenAI the ones that are clearly winning? Where are the kind of the middle, where's the middle ground where actually there could be a are we getting to the point where we're beginning to understand the nuance around what is happening in this space and investors start acting accordingly? Again, I think Nvidia will be interesting on that front. Let's talk about one of the headlines that Anna just read, talking about what's happening with Russia. It does seem as if there has been a fundamental shift at the White House in terms of the view of what needs to happen next with Russia. Trump, the language is changing. Putin's playing with fire. There's hint of more sanctions. It looks like this Lindsey Graham bill is going to be supported by the White House. That seems to be the kind of the next kind of piece of action that we're going to see. Graham was writing a piece, I think it was an op-ed in the Journal, or writing a piece in the Journal talking about the fact that he is coordinating with the White House. So it looks like more sanctions are coming. But do they go far enough? And do they have a material impact in terms of what Putin is doing? There is no hint at this point that the US is going to support further rearmament of Ukraine. Ukraine is desperately in need of interceptors in terms of air defence. Are we going to see those coming through? How do the Europeans step up? Zelenskiy's in Europe today. Can we fill the gap there? There's a lot of unanswered questions around what happens next.
As you say, Lindsey Graham suggesting he's working with the White House. If we see more clues from the White House themselves that they are really going to back this bill, then that would be, of course, a huge move. But as you rightly say, is it going to go far enough? Is it going to do enough to try and bring Russia to heel here? And I'm reminded of our conversation we were having yesterday, which pulled out some of the details of the Graham bill, talking about 500% tariffs on countries that import oil from Russia at prices that are above the cap that the G7 has imposed. And that puts India in the crosshairs, that puts China in the crosshairs, of course. And you wonder what the broader, wider geopolitical implications of a bill that has such far-reaching sort of geostrategic impact, you wonder what that's going to be.
And that's just the oil story. We still have to talk about copper and aluminum, which Russia also supplies to the global market. But the Zelenskiy story is interesting. Greg Sullivan, our reporter in Dubai who covers Russia from there, made the key point that you can get the green light from Germany, for example, on those long-range strikes, but they still don't have the machinery. That bit hasn't been sent over just yet, so I wonder if that changes after that meeting.
I am fascinated, though, by what Merz is saying on the German military. For 80 years, the German military has been in hibernation, and Merz is now talking about building Europe's most powerful military. Obviously, France and the UK have nuclear weapons, but he is talking about spending a great deal of money to produce Europe's most powerful military. Just from a historical context point of view, I think that's absolutely fascinating. Let's talk about where we're going on today's show. We've got some great guests lined up. Sri Kochagovidan, Aberdeen senior research economist, is going to be joining us. We'll fold in what we know, what we don't know about what's happening with the Japanese bond market. Eric Whiteness, JP Morgan Private Bank, EMEA Head of Investment Strategy, is going to be joining us. And KKR, EMEA co-heads, Mattia Caprioli and Tara Davies are going to be joining us a little bit later on. A conversation about what is happening within the wonderful world of private equity, Chrissy.
Absolutely. Lots to talk about, especially when you look at the interrelation of the long end as well as long duration assets as well. We already talked about some of the other things on today's agenda. We talked about Zelenskiy in Berlin. We talked about Nvidia. There's a couple of other things to flag to our global audience, which is, of course, the OPEC Plus ministers holding a virtual meeting today alongside the minutes of the May 6th FOMC rates meeting as well. So this is going to be two potential places where we may see some sort of conversation around inflation and impact in either direction.
Yeah, I was just reading the Bloomberg Economics sort of heads up on the big OPEC Plus meeting that is coming and saying that the market is braced for another 411,000 barrels a day increase. But even if we got a pause, even if we didn't get that, the market has been kind of, OPEC Plus has shown its cards, if you like. It's quite clear the direction of travel, the approval of these big output hikes, and Bloomberg Economics suggesting that this would be one more step towards a price war within the energy sector. So we'll certainly watch for headlines coming out of that one.
Absolutely. It's going to have a big impact on the shale patch. You're already starting to see the effect coming through. We're getting to the level at which maybe it's uneconomic to pump oil out of the US shale patch. How does that code change the equation as well? What else you need to know this Wednesday morning? SpaceX has suffered a third straight setback for its Starship program. The latest test flight saw the rocket suffer a leak, tumble out of control in space and then disintegrate as it hurtled back to Earth. Despite the failure, SpaceX emphasized that it learns from every test flight. It is a test flight and will continue to improve its systems with the ultimate goal of developing a fully reusable rocket for transporting people to Mars and beyond. Germany plans to introduce legislation that will put an end to fast-track paths to citizenship that currently allows some migrants to naturalise after 3 years. The move is part of a wider effort by the new Conservative leader, Friedrich Merz, to make Europe's largest economy less attractive to foreigners. The Cabinet is expected to approve the bill later today. And the Trump administration is moving to cancel all remaining federal contracts with Harvard University. In a letter seen by Bloomberg, federal agencies have been directed to review their contracts and terminate those deemed as non-critical. Sources estimate the contracts are worth more than $100 million. President Trump has been targeting Harvard over its diversity programs and alleged anti-Semitism. This comes as well as we see America basically pausing foreign student applications.
Yeah.
America thrives on foreign students coming in, feeding its tech industry, feeding its industry, feeding its knowledge base. This does seem as if this could have a longer-term impact on what is happening with the US economy. This is a key input into the US economy.
I suppose the argument that the sort of opponents of that view are making is that some stay, yes, and find their place within American society and within the tech industry. Others come and are funded to a small degree by the US government, but do have some US government funding, and then they go back home. And I suppose that's what the Trump administration, along with the more complicated anti-Semitism allegations.
They get back home with a relationship to the United States, an understanding, contacts, people they know. That relationship is embedded.
That's a soft power thing,
exactly.
Isn't it?
Yeah.
Yes.
A massive alumni network. It's funny, I was talking to some folks back home who were debating the story, and a lot of the people who have kids who are applying to colleges at the moment are suddenly saying that admission rate into Harvard is about to go higher because of that 30% that's basically, I don't want to say eliminated, but eliminated from the student pool and might be as well. So suddenly got easier to get into Harvard, which I thought was a funny take. The other piece of this is the endowment as well. And this is such an important piece, $53 billion, setting the tone not just for Harvard, but for all of the kind of university endowments. That's a massive, we're talking about trillions of dollars of assets, whether it's in the bond market, whether it's in the private equity market, that could suddenly hit investors. And that brings down valuations, which is problematic for people who don't want that to happen.
OK, so we'll watch this story from many, many angles, of course. Coming up on the programme, BBVA's Sabadell bid is under review by the Spanish government. We'll check on those shares at the open. Plus, Nissan looks to raise $7 billion to keep its operations on track. We'll bring you the details of that in this Bloomberg Scoop. Up next, back to markets. We'll dig into the bond story and how global growth fears are keeping investors on edge. If you have any questions, if you want to get in touch with the team that puts together the programme, IB plus BBTV Go is the function to use on your Bloomberg terminal. Wednesday, the 28th of May. This is Bloomberg.
Nothing's really changed in the economic environment. You just have policy uncertainty. And I think people are just going to wait policy uncertainty out. They do think there's a light at the end of the tunnel, that there will be some certainty, that whether it's the tax bill or some of the trade terms. But I think they're just waiting it out.
Richmond Fed President Tom Barkin speaking exclusively to Bloomberg there. It was a really interesting conversation. Go and have a listen to what he had to say. Companies are basically just waiting. They're not cancelling projects because the economy still looks okay, but what they're not doing is driving forward with new projects. They're basically, as he says, parking at the side of the road, waiting for the fog to clear. They've got their hazard lights on. They don't know what's going to happen next. That's certainly one story that we're focusing on right now. The story of the morning is what's going on in Japan once again. We started the show. I don't understand the connections and what the importance is of the Japanese 40-year to the rest of the global economy. Let's try and get some answers on that. Sri Kojagovidan, Senior Research Economist at Aberdeen, joining us around the table. Good morning.
Good morning.
If you'd have told me 3 months ago that the Japanese 40-year was going to be important and I should be paying attention to it and I should understand the connections with the rest of the world, I'd have said, no, that's to the left of left in terms of the terrorists that I'm watching. But here we are. We're worrying about it. Japanese investors are super important to the global economy. So I'm wondering how important what is happening with the Japanese 40-year is to the global economy. What are the contagion risks? Can you help me draw some lines here?
Yes, I think actually going into this auction, there was some expectation that this would be weak. We had, I think, a series of events, a bit of a perfect storm last week, which started actually with the Moody's downgrade for the US.
Yep.
That led to, there's a lot of correlation across the long end of the bond markets, across developed economies. And part of the root cause of that would be concerns about deficits, and the increase in yields would be adding to that problem of deficits, deficit financing. So that was part of the problem, and that led to a correlation across Japanese bonds and developed markets. But on top of that, Japan specifically is sensitive because it has a structural demand issue. There's been very heavy issuance at the long end of the Japanese bond curve. Demand from life insurance companies has declined steadily over time. This is not new news. This has been declining for a while now.
It's just news we haven't paid attention to.
Exactly right. And suddenly it's becoming a focal point because of the correlation across developed market bonds. Right. But I think there are some good signs here. I think, to be honest, today's market moves are a little bit of a jitters. It's quite small compared to last week's moves. Sure. We've had a few developments actually over the weekend. First of all, in terms of trade, obviously US-European trade, U-turn or reversal of tariffs. That was one piece of news. That does impact bond markets as well, as we can see. We also had the Ministry of Finance in Japan is talking to market participants. They are taking this seriously and they are on top of it, and that's good news.
Yeah, so what do we need to watch for here that really stabilises our thinking? Is it in the hands of the Ministry of Finance, and it's all about, whether they issue 40-year, 30-year, 2-year, whatever?
Yes.
Is it around fiscal sustainability, which is much more long-term thinking from the government? Or is it something that the central bank can deal with and step in and pay attention to? Because they are flagging concerns around how the 40-year affects the short end. What is it which actor are we watching to take action here?
I would say all of the above. I think in terms, starting with the Bank of Japan, it's going to be more difficult for them to act. I think the next meeting, which is June the 17th, that will be important in terms of what he says in the press conference. It's unlikely that they'll change their pace of purchases. They have been tapering purchases for some time now, but they are due to announce future purchase plans. So that will be a key focal point. There could be some jitters going into that meeting and around that meeting. That's one thing. June 20th is where you have the meeting between the Ministry of Finance, just 3 days later, Ministry of Finance and primary dealers. So this survey that we're having now, that news flow will be continually coming through. And we'll hear more about what the issuance plans could be.
So, Sri, I hear you on that, but speaking to I think the point that Guy and Anna, we see so much of this tumult when it comes to the deficit story. We see it kind of have a ripple effect in the States and back around Asia. Where we're not seeing it is hitting the European bond market, and I don't understand why. And we did see it to some extent in the gilts market yesterday. I think that's fair. But we haven't seen it in the other pockets that are having the same deficit concerns and the same fears: the French market, the Italian market, the Spanish market. So I'm curious why that contagion doesn't exist in Europe to the extent that it exists in the States and to some extent in the UK.
Yeah, I think you're right that they have been moving, but there's more idiosyncratic sensitivities in the gilt market, unfortunately, and that's something that's been persisting in terms of sentiment. That's something that's persisted for the last couple of years because we had that turmoil a few years ago from mini budget, and Japan is very sensitive. So it's that relative sensitivity. I think that's what we're seeing in terms of those relative yield moves. But I don't think Europe is completely out of the woods here. Right. It's just at the moment the focal points are around this one auction, 20-year auction, and then the 40-year auction. I think there are just key focal points and that allow this sensitivity and divergence in yields.
Do we need to be paying attention to the inflation story? In Japan, it feels like we've talked so much about how import costs are going to get increased by oil and the currency and et cetera, and it just feels like that's completely fallen off the radar, at least briefly. When does inflation become tradable again?
Yes, I think the inflation story in Japan, yes, it's at historic highs. It is trending lower. But if you look at the breakdown, what's driving inflation at the moment? It's food prices, and particularly rice prices have gone up 98% year on year. So that's a real driver there. If you take that out, the underlying trends in services, core services inflation is still quite stable, and it's not quite in line with target consistent. So I think that's why the Bank of Japan are waiting to see what happens with inflation. And there's a lot of uncertainty around the data for the rest of the year, actually. So I'm actually expecting they won't hike again until January of 2026.
So that's Japan. Thinking about inflation brings me to Europe and what we saw yesterday out of France, and we might see more of this. So the French inflation number coming in lower than expected and really low by recent historic standards. Lots of voices at the ECB claiming, you know, a lot of success and probably rightly so in bringing down inflation. Philip Lane saying nobody at the ECB is talking about dramatic cuts. But some of these inflation prints from the largest economies in Europe, at least, are starting to look quite low.
Yes, I think there's been, across a number of different countries there, that you've seen a downtrend, which is very, very healthy. But I think at the moment what we're seeing with the impact of the trade talks and the uncertainty there's a risk that growth will be weaker, and again that demand-driven inflation will continue to trend lower. So there is greater scope for the ECB to start easing relative to other central banks. So we do expect another couple of cuts later this year, for sure.
When does the trade war show up in US data?
I think the second half of the year, it's all a bit scrambled at the moment. It's coming through in terms of surveys, but not the hard data. In terms of the hard data, you really need to be watching the labour market data going forward, and then really looking at different sectors as well. But
does it just suddenly show up? Are we going to get to the point where we're kind of nothing, 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 and then boom?
I think not quite boom. I think we'll start filtering through. It depends on which series you're looking at. So investment is on hold. Hiring decisions are on hold. And nobody can make those decisions while we don't know what the parameters are.
Precisely.
And so that will start to filter through in the activity data, I'd say Q3, Q4 onwards, and we'll start to see signs of it really building up at the end of the year.
All right. Sri Kochugovindan, senior research economist over at Aberdeen, walking us through the dynamics of the Japanese bond market and perhaps why nobody else, at least here in Europe, seems to be reacting as fervently. Coming up, we're going to continue that conversation and dive back into that market reaction. Japan's 40-year bond, it is our top story, showing its weakest demand since July, risking further volatility in the global debt markets. We're going to dive into the ripple effects there, the contagion story there, and how much of this might just be a kink in the curve. We're going to get the latest next. Stick with us. This is Bloomberg.
We have a couple of pieces of CEO news that I think are probably worth paying attention to this morning. I'm going to start with Stellantis. We should also talk about Remy. Stellantis is naming, we understand, Antonio Filosa as its new CEO. Remember, Carlos Tavares out in December. It's been a while since this company has had a boss. I think Filosa is a native of Naples, but really comes at this from a kind of US angle. I think that is where the focus is likely to lie. We've also got Remy out this morning as well, naming Frank Maroli, I think, as its new CEO as well. Both companies, you could argue, in a difficult spot right now. The car sector is in a difficult spot. The drinks industry is in a difficult spot right now. New CEOs coming in, a new sense of direction maybe from both businesses. But the Stellantis story is fascinating. They haven't had, Tavares was out a while ago. It's taken a while for Elkan to figure out exactly who he's going to put in the role, but it does seem as if this role suggests a big focus on the States.
It's fascinating because that's also, not only is that a tariff story, but it's a pain point for the U.S. as well. 15% drop in sales for Stellantis. The expectation was 12%. So that's a part that's really bleeding. So you need that expertise as well. I think Remy Concho is dealing with the same story, though, but coming at it from a completely different perspective because, yes, they are feeling the tariff pain. Yes, they have to navigate that. But no, they're not leaning into the U.S. expertise there.
Yeah, no doubt that having the right person doing these jobs is really important. But both of these people are going to have to be real price takers when it comes to a lot of the environment they find themselves in. So the tariff story, for example, certainly will loom large on their agenda, as you both rightly point out. Let's have a quick look at where we are on markets then. And this is the futures picture for Europe. It's a little more lacklustre than I was expecting to see it, actually. I mean, we saw gains in the U.S. yesterday. A lot of that, of course, was catch up for what Monday saw in Europe. So there is that excuse. But we did continue to see some gains after Europe closed, and we factored in all kinds of reasons to be a little bit more cheerful. A drop in yields, of course, trade optimism, a rebounding consumer confidence in the United States. So all of that could have been used as an excuse to send stocks higher in Europe, but it's not going to, it would seem, from the futures picture. US futures flat to negative as well. And this is the picture across the bond market, and interesting to track that we do see very small movement in these European bonds. To your point a little earlier on, you were talking about how, yes, we continue to see read across from Japan into treasuries, into gilts, but not quite so much into other parts of the global bond universe.
Absolutely. And this has been, as our guests in the last block pointed out, a point of weakness for quite some time. The markets are just now choosing to react to it. And we're seeing that in two consecutive auctions that ended up being weak. First in the 20-year and now in the 40-year. Not traditional maturities, but certainly something that twice in a row could cause some pain. We are, of course, seeing yields higher this morning across the curve. And that kind of boosting the Japanese yen as well. We're going to dive into those dynamics with a true expert who could perhaps explain what is going on. Ruth Carson joins the program, the Bloomberg G10 FX and rates reporter, joining us from Singapore. Ruth, can you just explain to us what's happening here in this long part of the curve?
Yeah, absolutely. It's not every day that you come on TV and the first thing that everyone wants to talk about is the 40-year auction of Japanese government bonds. But it certainly bears looking at because of the volatility caused by this traditionally sleepy part of the market until recent times. So what's happening is that the auctions have been coming in weak, demand has been weak. Societe Generale, for example, has come out today to say that the 40-year auction results were unimpressive because of this fear of inflation, fear of the unknown when it comes to Trump's trade war and what that could do further on to term premium and also all the inflation jitters around. So in many aspects, people are looking at Japan now as a litmus test, particularly when it's something as notable as the 40-year bond, ultra long, on investor appetite for it. But yes, the spillover today has been a little bit more muted.
It's interesting. I think we're all still trying to understand and figure out the connections. Maybe there aren't any this morning, but I think it's fascinating to continue to pay attention to that. Today's big take is on Asia's Sell America moment, how Trump's policies are turning US markets from a sort of beloved destination for Asian investors into a source of volatility and to a certain extent pain as well. What do we need to think about when we talk about this story and how much pain there could be felt? And ultimately, are we going to see a de-dollarization in the Asian region?
It's an incredibly important story to unpack, I believe. It's $7.5 trillion worth of US investments by Asian investors that's been building for the last couple of decades. And so that is what is at stake. What I have been reporting on and my colleagues have been reporting on, talking to life insurers, pension funds, head of trading desks, is that there is a sense that we are at a pivotal moment in history where this Titanic is finally turning. People are actively questioning, should we have that much, investor in the US and ultimately the US dollar, it's treasuries, it's US stocks and all that. And the general consensus is that everyone appears to be moving. Now, remember, it's $7.5 trillion. A little bit coming back into this part of the world can cause enormous ructions. And we've seen that. We've seen it in the Taiwan dollar. We've seen it in the sell-off in treasuries, in the aftermath of the April 2 tariffs. And the consensus is brace for more vol to come. This is just a start.
Ruth, are we right to think about this by geography? Because, yes, this has been an ongoing topic of conversation, and clearly your big take story sets out very clearly where we're seeing Asian investors questioning whether they want to send all that money to the United States. But I suppose the more immediate dynamic, is it just that in lots of geographies around the world, investors are questioning whether they want long-end exposure to government debt, whether they're nervous about fiscal sustainability. And in that sense, maybe it's not really about de-dollarization. This story today, this week, last week, is really just about concerns around sustainability of government debt.
Absolutely. And it is a global story. It's not purely a US-centric story, although Trump's policies on trade in particular and rewiring the US economy is obviously exacerbating and augmenting the risks here. But definitely there is a soul-searching among rates traders. And, the term that we all know, bond vigilantes, are they actually gaining in power when all these dynamics are in play? Certainly there is a case to be made that it is a global story. Inflation fears are everywhere. And particularly in Asia, that's why we're seeing, currencies like the Taiwan dollar that has been weak for such a long time, and where rates are low and all that, are definitely feeling more of an impact. In South Korea, that's another good example.
Ruth, great to catch up. Thanks for the insight. Really appreciate it. Ruth Carson, Bloomberg G10 FX and rates reporter, joining us from Singapore. Let's turn our attention to how some of this volatility is manifesting itself in terms of company profitability. Citadel Securities has posted record profits and trading revenue in the first 3 months of the year, with $3.4 billion in net trading revenues and $1.7 billion in net income. Bloomberg's Charlie Wells has been crunching the numbers. This is an impressive pickup on a set of impressive numbers last time round. Walk us through what we're seeing here.
Yeah, so this is a 45% increase from the same period last year. And it really is just kind of, the epitome of good volatility, right? This theme that we've been seeing all earnings season of volatility really kind of throwing a spanner in the works of a lot of these companies. That is not the case for Citadel Securities. So they are really seeing, in the same way that we saw for a lot of banks trading businesses, right? They saw a lot of boost in their trading. And I think this number that really sticks out to me, almost $10 billion that they brought in net trading revenue last year. That is their largest haul since 2002. And so this just speaks to the fact that, trading is really benefiting from volatility. But in some ways, there's also been a secular change. I want to talk about this in a little bit of a moment. But the retail trader, too. And I think that's what's really interesting with Citadel. They do have that strong connection to the retail trader as well. So it could be an interesting tell going forward on the health of that trader.
How long does it last? The next 4 years, maybe?
Yeah, I mean, let's see. Do we keep continuing to profit off kind of changes or right-way bets as we go? I think the question here, and I want to get to that retail point, Citadel handles a third of U.S. retail trading. So they do have that strong connection. We really saw them kind of get a huge boost during that meme stock 2021 episode, and that's just kind of continued here. And I think what's been interesting about the retail trader, they were responsible for 20% of U.S. equity volume in that first quarter. And I think to get to your question about does this continue, do we get a recession? Do we get to a point where that retail trader doesn't feel quite so confident? We've been hearing about this for a long time, but we haven't had a recession since that 2021 moment.
Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on Citadel, following in the steps of others and setting its own path. Record profits then for that market maker. Now, UBS Asia-Pacific President Iqbal Khan says he expects rates to come down in time. He spoke exclusively to Bloomberg at the UBS Asian Investment Conference.
We expect continued volatility. And in that perspective, I think being diversified, thinking in scenarios, that is absolutely key. We do continue to expect that rates will come down. It's a question of time. And of course, as we see further data come out, and also just let's not forget the uncertainty we still have around tariffs and the environment itself. So I do feel that while we will see rates come down, it's a question of timing. We've definitely seen a significant growth of alternatives and alternative investments in clients' portfolios. It is still at a lower percentage when you think about an aggregated perspective of wealth portfolios. So there's probably still some way to go in terms of diversification into alts.
That was the UBS Asia-Pacific President Iqbal Khan there. And Kriti was talking about appetite for alternative investments, which given, and we'd said this at the top of the programme, we've got a conversation with KKR coming up, given the focus on private equity, on investment in infrastructure and all those other areas of alternative investing. Interesting that UBS sees a lot more room for growth on that front.
It's kind of the new popular trade, isn't it? Because it was private equity and private markets had their moment in the sun, I want to say 2 years ago, at the same time that the carry trade was really popular and term premium was a discussion. And then there was just this moment where everyone said, hold on a second, in volatile times, in tariff uncertainty, do you want your market or do you want your liquidity wrapped up into something that you can't actually access for, say, 10 years' time or 5 years' time, et cetera? And yet it's still having its moment. People are still throwing money at it because there's a question of where else do you go to get that same yield?
Yeah. There's an exit issue. There's so many kind of growing, burgeoning issues with this sector. I'm also quite interested to find out, when we talk to KKR a little bit later on, about what is happening with the overlay of a cheaper dollar.
Yeah.
What is happening there? How do you use this asset class to diversify? How do you think about using it for that purpose? Is it good for that purpose? Is it something that people should be thinking about? How does Europe benefit, not benefit, as we see private equities making a bigger footprint here? If we do see tariffs coming in, how are they calculating that risk?
Yeah.
Which we're all trying to work out, but how is it working within this space particularly?
It's fascinating as well because a lot of these major private players, because to your point of how do you calculate that, there's been a question of do you have to be a large-scale player to excel in the space? Do you have to be a KKR, an Apollo, an EQT, as opposed to a smaller player? And that's where you've seen the divergence because they're dealing with that capital markets glut that you're talking about. But the bigger players are also having conversations with the leaders of Europe as well, because they're trying to attract that investment at scale that they can't do in the public market. So a lot of these folks, hopefully some of them that we're going to be talking to on this program, have had that conversation with Christian Merz, with Emmanuel Macron and others.
Is it a signal? That's just a representation of the fact that European markets are broken or not complete or not working properly. The fact that normally you would think if you had the same market operations that we have in the States in Europe, would they have the same role to play? But because you don't have cross-border trade, because you don't have single markets in financial services, is Europe therefore a greater, more fertile ground for these people as a result of that? Yeah.
What does it tell us about the role of private markets in Europe? How much is that an exciting opportunity for investors, and how much is it an area to be concerned? Lots to talk about.
Lots to talk about. Is AI, is defense on the agenda? We're going to dive into all of it. We're going to get some answers from KKR's co-heads of EMEA. An exclusive conversation around the table. Joining us, Tara Davies and Mattia Caprioli joining us in about, I want to say, an hour's time-ish. Very excited for that conversation. But coming up for now, we're going to look into what a new CEO at the helm of Remy Cointreau could mean for shares at the open. That and your other stocks to watch next. This is Bloomberg.
30 minutes of the market open. We are looking at a really unexciting set of futures right now. As you can see, we're going nowhere in a hurry. What does that tell us about kind of where we are? Are we, as Thomas Barkin was talking about earlier, in the fog, trying to figure out where we go from here? That's kind of how markets feel this morning. The consumer, though, in the States, not feeling too bad right now. And that apparently is catching Kriti's eye.
It's a fascinating one because we've seen this dynamic before. And there's a couple of spots in the chart of this consumer confidence story that I want to talk about. The data yesterday showing a biggest boost in about 4 years. So a complete turnaround, because remember, the last couple of data sets have been the biggest drop in a couple of years. So real volatility in terms of sentiment. But I want to take us back into history here because this really has a lot more to do with the stock market than it does necessarily how people feel about tariffs. In fact, if you were to overlay this chart with a stock market chart of the S&P 500, the lines would look fairly similar. But I want to take this all the way back to Donald Trump's first administration here, because that's really where the trade story and the tariff story first emerged. And it's right here in 2018, this drop that you really want to keep an eye on, because that's when the market started dropping in the fall of 2018. Some of that had to do with the hikes coming out of the Federal Reserve, the hawkish tone there as well. But then you see that again kind of rebound, and then it becomes a very choppy set of data as we navigate the trade war that under the first Trump administration. We're seeing a similar dynamic now, where if you actually look at the drops here in terms of that tariff story, a real hit to consumer sentiment, Anna, but a rebound as the stock market rebounds as well. So do we need to even be looking at the shipping data in the ports of LA and the ports of Long Beach? So we just need to look at the S&P 500.
Yeah, is it the S&P 500? Is it the news headlines around tariffs that cut through? Certainly something is cutting through to Main Street, isn't it? And having an impact on their expectations and their sentiment. Let's talk about the markets in 3 minutes. Markets Live Executive Editor Mark Cudmore joins us now. And Critty was talking there about the bounce back in consumer sentiment, Mark, and that was just one of a host of items that drove stocks in the US higher yesterday. That resilience that we're seeing, that push higher, OK, it might come to an end today, but that push higher in US stocks, has that come as something of a surprise?
It's been very impressive price action in US stocks, and like Critty, I was quite stunned by that rebound in consumer confidence. I think the nominal levels, are still well down from where they were only a few months ago, because we really fell a long way, but it was quite a powerful bounce, and we seem to be seeing this impact that we get a threatening tariff headline, we get a Trump reversal, and we nearly seem to be in a better position than we were before, which doesn't really make sense because there is uncertainty for businesses, there is raised costs for businesses. As we know, in April, we talked a lot about we expected a relief rally. Markets had got over bearish on what's a very, very long-term multi-year theme of the end of US exceptionalism. But still, this resilience has gone further than I expected. Price action is very good. And I think the pain trade from here is to continue to squeeze higher. So maybe Nvidia beats tonight. That said, the backdrop, the long-term trade, we always said this, Guy asked whether we're in the fog right now. We are in the fog. We knew that we were going to be in the fog because the hard data is probably not going to show real pain until at least June and maybe not till July. And therefore, we always knew that this was going to be a really tough period to trade because the long-term structural trades are clear. The Sell America trade is valid. Dollar weakness long-term. Treasury is going to stay under pressure long-term. And US stocks will underperform. But are they going to underperform in a bull market or a bear market? That's what's harder to know.
Mark, I'm trying to figure out the 40-year, the Japanese 40-year. I've never cared about the Japanese 40-year before in my life. And suddenly I care about the Japanese 40-year. How is the Japanese 40-year connected to the rest of the world? Why do I need to worry about it? Should I be worrying about it? Is this some sort of systemic risk story that I need to be thinking about folding into other asset classes?
Yes, I think the short answer is yes. We probably don't have time to go in the details of that. For the details, probably read my colleague Simon White's piece on this, excellent, from a week ago, Macroscope column. But the fact is, Japan has this massive debt. Now, yes, a lot of the debt is owned by the BOJ and it's owned domestically, but that doesn't change the fact that they've got this very, very large debt pile, and many people see that the long-term outcome is they're going to have to monetize it. And now with rising inflation, rising yields, they're in a bit of a negative spiral there at the moment. And the fact is, if Japanese investors, who are one of the largest holders of foreign assets around the world, particularly US assets, if they bring capital home to buy higher yields in Japan, that's going to have knock-on consequences around the world. So that's the short answer. Not enough time for the long one.
All right, well, putting you on the spot, Mark, 20 seconds. When does that sentiment bleed into Europe?
I think it will do. I think this is a global debt reckoning, but this is a really long-term story. We were debating this morning, is this even a story for this year, or is it more for next year? I feel like we're at the initial stages of this debt blowout. How quickly it moves is really, really hard to predict. These things go very quickly, then really slowly, and then suddenly they go off a cliff again. I don't think we're at the cliff yet.
A couple years to watch, according to Mark Cudmore, perhaps. We thank you so much for that analysis this morning. Get more from him and the team. The long version, as he says, MLIV Go is the function on your terminals. Go from the macro to micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So we've got a couple of auto stocks on the radar today. Firstly, this one's standing out for me. News that Nissan could potentially be looking to sell a bit of their stake in Renault, the French company. We can see Nissan stock really being an underperformer in that market globally, and therefore the company, according to our reporting, looking to raise around $7 billion worth of cash, and that stake on the Renault shares could potentially be a target for them. Then we've got Stellantis, news of a new CEO coming in. Now, he was previously the COO of the American operations, and that is where they've seen the big drop down in sales in terms of the owner of Jeep and other brands. So potentially that is going to be taken as a positive if he's able to turn around that brand. Then we can see that stock down around 55% on a one-year basis. So that could potentially be a bit of positive news for them today. Then a stock that is definitely not going to be positive, according to the calls and analyst reaction, at least, is SoaceX. This is in wafers. Now, this is the material that is used to make semiconductors, and the company pulling its guidance over in France It has had a profit warning already this year. In February, we can see that stock down 50%. They've been hit by weakness in autos and also in cell phones as well. Seeing a lot of negative calls on that one. Quite a few downgrades in terms of analyst price targets as well. Keep an eye on SoaceX today. Then, continuing the theme of CEO changes, Remy Cointreau, they've got a new leader as well. Now, the interesting point for me is that the new CEO is actually a trade advisor for the French government as well. So potentially this is kind of playing into the tariff concerns that have hit the drink stocks in the past few years. Now we can see Remy, another one that's been down a lot, down around 60% on a 5-year basis. We can see a lot of sales on that stock. They have had a big slump in sales in general alongside the tariff issue. So again, a bit of a refresh in terms of management. Keep an eye on Remy, potentially positive news for that one today.
Thanks very much. Joe Easton, of course, our equities reporter. Now, the European futures picture looks slightly negative, as the US futures. A lot of positivity yesterday, certainly in the US, but it seems we're done with that. That was all Monday.
Felt quite squeezy. It sort of all changed over the weekend. It felt like maybe actually the market was just a little bit short, and as a result of which we just squeezed higher. There was probably money being pulled in. I think somebody made the point earlier that it was maybe kind of we're getting towards month end. Are we there yet? It's the 28th. I guess you could probably say that there's probably some month end factors there as well. Anyway, the opening trade is almost upon us. We're 5 minutes away. That's next. This is Bloomberg. What was yesterday? I'm not sure we actually got a clear picture yesterday as to kind of how investor sentiment is shaking out right now. The white line, I think, is basically kind of a marking time moment. That's the European session yesterday, which was largely open on Monday. The US reopened yesterday, and we got this rally. Part of that was driven by the reversal on the trade story. Apparently, we're accelerating talks with Europe, and it's all going to be great, and nothing's going to happen, and nothing to see here, and we can move on. And the other thing is that consumer confidence looked fairly rosy as well. I think actually the second bit is probably the more interesting bit in some ways. Anyway, the US session rallied quite strongly, but if you look at futures this morning, it's a bit meh. There's nothing really happening today. So we kind of had a little bit of repricing. It came Tuesday rather than Monday, but today feels like the first proper session, Critty, of the week.
Well, it's only natural. If you start to go rally into the close, to have a little bit of a pullback in futures, completely normal. And that's exactly what you're seeing this morning, Anna. Your Stoxx 50 futures down about 0.3%. I think that key point the guy made earlier about the rebalancing trade may be what's keeping these markets kind of cautious.
Yeah, pretty cautious, aren't they? And US futures pointing tentatively lower, pretty flat to negative, let's say. Let's have a look at some individual stocks that could be on the move, and we will start with what we have learned about the important things to have on your LinkedIn profile when it comes to going for a new CEO job. One of those is experience in the US market. That applies to the new boss over at Stellantis. The other is experience in trade conversations. That applies to the new boss at Remy Cointreau. So at both of those businesses, we have new leadership coming into position. And then we were also focused on Spanish banking, BBVA and Sabadell. We've heard, of course, that the government is going to take its time on that particular M&A story. They're going to conduct their own review after the antitrust watchdog did the same, Guy.
OK, here we go. Wednesday session. First proper session of the week, I would argue. Let's take a look at what we are seeing. Here we go. We've got a very flat picture, I think, likely to emerge. FTSE 100 certainly delivering on that front. First thing, look at that. That's an exciting open, isn't it? We're down by 0.03 of a percentage point. We'll give it a while. We'll see whether or not we see further action and whether or not there are some single stocks that we need to be focusing on. But the market is back to kind of marking time, trying to figure out what is happening, trying to understand the implications of what's coming out of Japan and the trade story and what the latest data are telling us about what the picture looks like with the global economy. Stock 600 is down an exciting 0.03%. The FTSE 100 is now absolutely flat. The CAC 40 is absolutely flat. The DAX is delivering an impressive 0.2% rise this morning. Take note of that. And the IBEX is down by 0.2%. I struggle to find a clear narrative out of the numbers that we are putting up on the screen right now, Chrissy.
I think I'll join you in that confusion, because it does feel like these are very small moves, even on a micro basis, that we are seeing. I mean, you are looking at kind of a split market in terms of the ups and downs. 262 stocks up, 280 down. So, again, really netting out to what you're seeing on your screen right now, which is kind of an index level. From a sector perspective, though, you are seeing basic resources, technology, financial services, and construction in the red. The rest in the green, but not by much, Anna.
Yeah, and overall, these markets are flat, which is a little better than maybe we were expecting. But we're pretty divided, aren't we, when it comes to the sector perspective, so that doesn't help us too much. Energy stocks are moving higher, retail stocks are moving lower, and everything else in between seems a bit of a mess.
There's a couple of stock stories that do stand out, one of which is Rheinmetall is up again. Friedrich Merz is talking about building the biggest, most powerful military in Europe for Germany. Rheinmetall continues to benefit from that. We continue to struggle to keep up with what is happening in the defence space. That certainly continues to be a narrative that is worth watching out for. So BAE Systems is also up on that. Safran is trading a little bit higher. Rolls-Royce, I think, picks up on the back of that as well. Even to a certain extent, we are seeing Airbus. Thales is also doing relatively well. OK,
let's get another perspective on these markets. So let's bring in Eric White-Ennis, who's the EMEA head of investment strategy at JP Morgan Private Bank. And very nice to have you with us on the programme, Eric. Thanks for coming in. So we're looking at markets that are twisting and turning almost daily still on tariff news flow. And do you have any sense, you've been thinking about the rest of the year, I know, and do you have any sense, or what assumptions are you making, if you don't have any sense of where the landing zone on tariffs is, what assumptions do you have to make about tariffs in the meantime?
I think it's important to try to recognize what the approach is here, which is a little bit outside the box, and it's perhaps not what we're all used to in terms of the negotiation. And it seems fairly clear that it's a place where things start a little bit here. There's a goal to land to a bit more of a reasonable landing zone, and that's ultimately where we think things will reside at the end of the day. Perhaps a low double-digit level on the overall U.S. net effective tariff rate, which we think is something that can be reasonably managed through a global economy that's showing an impressive ability to ebb and flex around it, particularly led by the U.S., where the dynamism of the U.S. economy is showing an impressive degree of resiliency. We think it makes sense to add strategies that will navigate this, but that flexibility has been important.
OK, and that chimes with what we were hearing out of the White House yesterday, you know, that if this is a 10% tariff, then, or maybe a little more than that in the end, then this could be something that the US economy, certainly the White House was talking about, can handle. It's not going to be such a big stumbling block, I suppose. Is that your base case, then, that we don't get a recession in the United States? The data just sort of flexes a little in the short term, but bounces back?
It is. We believe that the U.S. economy will ultimately skirt recession. We certainly could have a degree of a slowdown. I mean, ultimately, tariffs such as these are an upside pressure on a degree of inflation and a bit of a downside pressure on growth. But as long as that does not go too far, a degree of a slowdown isn't the end of the world for an economy such as the U.S. Remember, recessions over time are typically short-term in nature. The market typically moves ahead of that. And we are seeing that flexibility of the U.S. and the global economy, and it's been noteworthy.
To what extent are buybacks propping this market up?
It's helpful. It's a simple supply-demand type of phenomenon, and we expect to see more of those as we go moving forward. The overall attractiveness to what's been happening with earnings in the U.S. has also been producing a steady buying hand that quickly came in amidst the recent market turmoil. And there's obviously a big debate about the phrase U.S. exceptionalism. And to some, it ultimately ends up being something that sounds a little bit of an either-or. One of the things that I would encourage focusing on is the fact that the U.S. does remain the dominant center of tech, the dominant center of AI, a magnet for talent, a magnet for capital, and a place with the most innovative free cash flow producing companies in the world. And if you think about earnings growth going forward, one of the things that is sensible to ask oneself is, do you think the U.S. will continue to produce robust earnings on a 5, 10-plus year type of time horizon? And if the answer to that is yes, which we very much so think that it is, we believe it's sensible to stick with the U.S.
So I take that question. I'll pose you another one. The earnings guidance and the earning increases you've seen in the States are largely based on consumers being able to digest price hikes that have come down from Europe and from the United States. But you look at the personal savings data, you look at delinquencies data, they're all ticking higher. So that price hike, which are likely coming down the pike from Walmart, Target, name your company, that digestibility feels like a red flag for the U.S., no?
There's definitely going to be a degree of headwinds that face the consumer in the months to come, and we'll see how the Fed might react to that. In particular, I think the payrolls data over the next quarter, when we're more so in the tariff digestion period, to use the word that you mentioned a couple of moments ago, that's going to be particularly important. The Fed often reminds us that there is not the concept of the so-called Fed put, But the reality is, as they focus on their dual mandate, helping to ensure prices are reasonable, i.e. help fight inflation, and also help support the labor market. If the labor market softens, I think we can expect a Fed reaction response if the consumer struggles. But just yesterday, we got a surprisingly positive number on consumer sentiment in the U.S., and that was encouraging to see.
One that was largely driven by the equity market. You can see that in the data as well. How does the Federal Reserve stop price hikes, though?
So I don't know that it can, and companies are going to do what is sensible for them. And that's where the health of the U.S. consumer comes into play. Can they digest these price hikes? What does it mean for the ultimate levels of inflation? Those inflation numbers have remained reasonable enough. We're going to get some more color on that this week, but you're hitting on some of the key dynamics. What is that mix between upside price pressure and downside pressure upon growth?
Sounds like you don't believe in Europe.
We do believe in Europe. So we very much...
But you'd rather be in the U.S.?
Yes, admittedly, we would. We recently upgraded our disposition on Europe. And again, I would try to view it not so much as an either or. We believe it makes sense to stick with the U.S., but at the same time complement what is typically heavy, long, overweight positions in the U.S. with a greater degree of exposure to Europe. I am extremely enthusiastic by the Draghi report-like German infrastructure package. For example, that is a big bang type of stimulus, about 12% of German GDP, a quarter of the region's overall economy. That type of amount and that type of decisiveness is very encouraging to see, and our hope is that it helps to continue to foster greater policy support, more inflows, and that's been supportive of European and international markets. It's also a bit of the story of the downward pressure on the dollar, that flow of funds coming back to Europe.
Does it matter if I'm a European investor or a US investor for keep everything in America strategy? If I'm a European investor, the dollar hurts. If I'm a US investor, it doesn't matter. Do we need to be a little bit more nuanced in what you're saying in terms of where my home market is, in terms of how I think about how I'm going to be investing?
It's a great point. The home-based currency topic is a big one, and it is fair to say that for U.S. domiciled investors that are kind of U.S. dollars all the way, so to speak, they are typically a bit less sensitive to what happens with the FX market overall. But for investors that are home-based, denominated in pounds, francs, euros, and so on, there is a greater consideration of that. Ultimately, we think that U.S. market performance in the quarters and years to come will be sufficient to compensate, even if there is a degree of a softening trend in the U.S. dollar. And we are very much so in the cyclical camp for the dollar and not the structural camp. And by that, I mean we do not foresee substantial risks of the U.S. losing its base reserve currency status anytime soon. The dollar is still used in 90% of FX transactions, 2/3 of international debt, 60% of international currency.
That's a very high starting point.
It is, and its status there, we think, is very much so secure. So if the dollar continues to soften, we think it will be gradual and relatively cyclical in nature and not something that needs to be a tremendous concern.
Can I ask you about private markets and what conversations with clients are like about how much exposure you want to have to private markets? We're going to have a conversation later on in this hour, in fact, around infrastructure spending in Europe, around private equity in Europe. And we heard from UBS, Iqbal Khan, talking about how investors could still get more exposure to that side of things. Is that an area of growth still? And what could put a lid on it, I suppose, is what I'm interested in.
So absolutely to us it is. And the two main areas that we've been leaning into have been relative value, macro and long-short hedge funds. We think that their ability to ebb and flex with this uniquely unpredictable environment makes a lot of sense as a cornerstone of portfolios. And then secondly, private infrastructure. I love some of the attributes of some of these private infrastructure strategies that we and some others invest in. To me, it is a very effective combination of three main things. Number one, bond-like consistency of cash flows, and everyone likes income for a degree of their portfolio. Number two, extremely low volatility. We've had a very smooth ride in the returns in some of these strategies. And number three, almost zero correlation whatsoever to broader public markets. So if you're focused on things such as what was just discussed in the prior segment, the level of JGBs, long-term yields, government debt themes, and things along those lines, These types of strategies can give you, again, bond-like returns, but are really on the side and allow you to sidestep any of those government debt concerns. So we think they make a lot of sense.
What limits your appetite for private infrastructure? What's the negative that we should watch out for? Because this seems to be a rich theme that many people have talked about for a long time.
Yeah. Some people have concerns about the degree of liquidity or lack thereof. Some worry a little bit if it's gotten too much focus of an overall theme. Data centers, for example, an area that there is almost universal optimism and enthusiasm. Some people believe that it's got a tremendously long runway to run. Others believe that it's gotten a little bit, too heavily focused on. We focus on old-fashioned things such as ports, roads, bridges. We also have a strategy that we lean into for clients focused on long-term contracted shipping routes, so-called moving infrastructure. So not everything needs to be the AI data center theme. We have those. We think those make sense, but a diversified approach within the private's infrastructure asset class, we think can serve portfolio as well.
Eric, great to catch up. Thanks for stopping by to see us. Really appreciate it. Eric Whiteness, EMEA, Head of Investment Strategy at JP Morgan Private Bank. Core 6 looks like this morning. Let's take a look at what we are seeing in the numbers. Fairly mixed and going nowhere in a hurry seems to be the overall story. A little sell-off into the safety trade at the right-hand side with Nestle down a little bit. But I'm not sure any of these numbers give you a real clue and a real kind of macro read as to what is happening out there. Let's talk about some other stocks that might, though, and some single stock stories that are interesting from a CEO point of view. Joe, what do you got?
So one stock that is going nowhere in a hurry currently, Guy, is SoaceX, but that is because we are in a volatility hole on that one. We are unchanged on that, but that is purely because there's too much volatility coming into that stock. So they can't actually open it in Paris at the moment, but we are seeing calls lower in the pre-market indications, down around 15% on that one when I stepped away from my desk. Keep an eye on the price on that one. Then in terms of the CEO news, Stellantis, edging very slightly higher. That one is down around 50% on a 2-year basis. So they've got the new CEO coming in, a lot of experience in the US. As Anna mentioned, if you've got a US experience on your LinkedIn, you are likely to get a CEO position, according to the statements we've seen today, at least. Stellantis coming up very slightly. Antonio Filosa coming in as new CEO on that one. Then we've got Remy Cointreau. Not so much a positive reaction on that one, but it is a new CEO at the drinks maker, another stock down sharply, and we're not seeing much of a reprieve for this one. Now, again, it is an internal appointment with some US experience at least coming in for that one in terms of Remy. That one might not be internal. I think that was actually the Stellantis one. Too many CEO changes to keep notes of, but the important thing, Remy shares are lower at the moment. Then we've got Kingfisher over in DIY. It is the owner of B&Q here in the UK, of course, but actually the weakness not in the UK, it's Poland that is weak, and also France not looking good in terms of the construction sales for that one. So Kingfisher, a bit weak. The international sales weighing on that one once again. It's been a bad run for Kingfisher shares. Then in terms of share sales, we've got a lot came through last night. We had a big flurry of them. Galderma, that is in the cosmetic space, a big one in them. In Switzerland, it was around 1.5 billion euros, I believe, in that one. Ferrovial in construction over in Spain, and also Strabag in Austria, construction as well. Share placings, people offloading stock following rebounds in some of those shares. Keep an eye on those. Then finally, to finish on L'Oreal, because JP Morgan warning in a note that the beauty market is weakening in both Europe and in the US. So they reckon that cosmetic sales, makeup sales, that kind of thing is going to continue to slide, and therefore they're putting this one on a negative watch, and we're seeing L'Oreal coming down more than 1%. Over in France this morning, L'Oreal is a negative view at JP Morgan today.
Joe, thank you very much. Yes, you're right, Frank. Marie-Lee at Remy Cointreau, the new hire there, is an external hire and taps into the story that Joe was just talking about there. Actually, his most recent position was at the Japanese cosmetics maker Shiseido, which he left just a little while ago. So we'll continue to focus on some of these new CEO appointments across Europe. Also coming up, another delay for BBVA's bid for rival Banco Sabadell as the Spanish government decides to conduct its own review of the proposed takeover. We're live in Madrid with the latest. This is Bloomberg.
Welcome back to the opening trade. About 19 minutes into today's session. Seeing some green on the screen here. Outperformance when it comes to the FTSE 100, but not by much. So we're going to keep an eye on that, see whether or not the green on the screen actually holds. In the meantime, a couple of individual stories we want to bring to your attention, starting off in Spain, where the Spanish government has decided to conduct its own review of BBVA's takeover bid for rival Sabadell. It marks the latest chapter in the ongoing saga to unite two of the country's largest banks. Bloomberg's Macarena Munoz joins us from Madrid with some of the details. Macarena, walk us through what the government can actually do from here.
Hi. So the antitrust watchdog approved BBVA offer last month with some conditions, and now it's the government who says that it wants to carry on its own review, claiming reasons of general interest. That would mean it will now have 30 days to study the proposal and could impose tougher conditions and even stop a legal merger.
Okay, in terms of how this is going to impact the deal, could this derail the deal? Could BBVA decide to walk away? What is the next thing that happens here?
Yes, so indeed, if the rationale of the merger changes due to the tougher conditions, BBVA could decide to walk away. But so far, the bank says that the merger makes sense and that it sticks to the proposal.
OK, thank you very much. Bloomberg's Macarena Munoz in Madrid talking to us about the latest in that bid battle within the Spanish banking sector. Another theme of this morning has been CEO changes. Let's have a quick look at Remy Cointreau and how the share price is responding there. We were just talking earlier on with Joe Easton about how this is an external hire to Remy, somebody coming in with a lot of experience in various sectors. He's been at Unilever, he's been at Shiseido, the Japanese skincare company. He's been across a host of different sectors. And that stock, though, down by 1.2% right now. Another CEO we're focused on, Stellantis, also has a new CEO. The car maker appointing its America's head, Antonia Filosa, to the role. Bloomberg's Caroline Conan has more from Paris. Caroline.
It took more than 4 months for Stellantis to replace Carlos Tavares, who was ousted in December after 10 years at the helm of Stellantis. And Bloomberg had reported that Antonio Filosa, the current head of Stellantis in North America, had been the top contender. And clearly, this is sending a huge message to the US. He is described as the anti-Tavares. He started his career at Fiat 25 years ago. He was a protege of the late former Fiat CEO Sergio Marchionne. And clearly, Tavares had huge clashes recently with the United States, with unions, with car dealers, with politicians about how Stellantis is handling their brands in the US. You know, they own Jeep, they own Ram, Dodge, and Chrysler, of course, and they've been accused there of not reviving fast enough the portfolio of these brands and really losing market share in the US. So we'll see if Antonio Filosa reassures investors, especially on the US markets. Of course, there is the uncertainty about Trump's trade policies, because even though Stellantis has a lot of production lines in the United States, they import a lot of car parts from Canada, from Mexico, and in fact they recently said that they were withdrawing, kind of suspending their guidance for the rest of the year due to the uncertainty about all these tariffs. They even at some point considered moving some production from China to Europe in order to avoid the potential US tariffs on China. The North America deliveries of Stellantis fell 20% in the first quarter, and the market cap of Stellantis has shrunk about 2/3 since the peak in March last year. So we'll see if Antonio Filosa can reassure investors, especially reviving the relationships with the US market.
Yeah. A protege of Sergio Marchionne. That's all you need to know. Caroline, great stuff. Thank you very much indeed. Caroline Conan joining us out of Paris. Let's stay with the auto sector. Bloomberg has learned that the troubled Japanese automaker Nissan is seeking to raise more than $7 billion from debt and asset sales to keep operations on track amid huge loan repayments that are going to hit next year. Let's bring in Bloomberg's Danny Lee on how they are going to achieve this. What do we know about how this is going to work, this financial engineering?
Yeah, Guy, this is going to come from a mixture of debt and asset sales, and it speaks to the real urgency that a new CEO, Ivan Espinosa, is looking to raise money and sell down on assets because of this huge debt wall that is coming next year. And given he's been recently installed, he's been taking a close look at the books and just to see how healthy or unhealthy the financial situation is, right? And so in terms of some of the numbers, Nissan is trying to raise 630 billion from convertible securities and bonds, including from the high-yielding US dollar and euro notes, and also looking to sell and lease back the headquarters particularly, and also to pare down some of its stakes in such as Renault as well. So there's a lot it's trying to think about in terms of trying to stabilize that financial ownership in order to try and look ahead and trying to ensure that it does survive in the short to medium term.
All right, Bloomberg's Danny Lee walking us through the Nissan story. We thank you so much for that crucial context. As Danny was speaking, we did get some headlines in the banking sector, this time coming out of UniCredit, talking about, again, yet another consolidation story, raising their stake to 20% in Alpha Bank. This is, of course, the Greek bank that they've had their eye on for quite some time. They're also asking for regulatory approval to pull that stake up from 20% to 29.9%. The shares rallying, it seems, off those headlines, Anna.
OK, so we focus on the banking sector. Also in retail, interesting that Reuters is reporting that Shein, the fast fashion brand, is planning a Hong Kong listing after its proposed IPO. We talked about this many, many months ago in London, had failed to secure the OK from Chinese regulators. So there's not so much about UK approval for any IPO in London, but about the Chinese stance. And of course, in the background to all of this, Guy, we know that the US is taking action on the de minimis rules, and lots of other G7 finance ministers have seen a sort of door opening, a way that they can try and tap into those kind of flows as well.
Absolutely. And UK retail, European retail has been pushing for this for quite some time. This has obviously been a huge headwind for retailers here in Europe and elsewhere around the world, and it looks like we're going to see some significant changes. But as you say, this is probably largely regulated out of the Chinese story. That seems to be where the impetus seems to be coming from here. Up next, we are going to turn to how private equity is viewing Europe. We are going to be joined by KKR's EMEA co-heads joining us around the table next. Looking forward to this conversation. It is coming up next. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. And will I go so far as to say this looks like a better session than maybe an hour ago we were expecting? I mean, it's all marginal, but we're up by 0.3% on the German DAX. The French market not doing too badly. Overall, though, pretty flat across European equity markets. US futures then pointing just a little bit lower, Critty. It seems that Monday's excitement is a long time ago. That was joined yesterday with excitement about the US consumer. But today is a new day.
A little bit of optimism around America, it seems like. We'll take a reprieve when we get it. Let's talk about that theme, though, and how it translates from the public markets to the private markets. Last week, we had a conversation with the chair of EQT, Connie Johnson, about how the Swedish giant is positioned to benefit from that trade-off. Take a listen to what he had to say.
The ones we're competing with is almost exclusively the US firms right now. And they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US, and maybe to deploy money with GPs that is not US based or US dollar denominated.
Connie Johnson, EQT founder and chairman there, of course, talking there about how that American exceptionalism trade, or lack thereof, is actually helping them operate more in Europe. So I want to expand on that theme and bring in Tara Davies and Mattia Caprioli, co-heads of KKR's EMEA operation, joining us around the table this morning for a conversation on that topic. Thank you both so much for your time. Mattia, I want to come to you initially and talk about that trade-off, because we talk about it so much in the public markets. The volatility emanating from the States means that the Europe bull case is kind of a no-brainer. To what extent is that showing up in the private markets?
Well, thank you for having us, first of all, Kriti. Great to be here. I would say Look, there's certainly a lot of volatility and uncertainty out there, and we're all affected by it. But we're seeing some positive signs in Europe, as Connie Johnson mentioned. Certainly, the Draghi report highlighted some areas where Europe could do a better job at regaining competitiveness. And we've seen what Germany has done with a significant shift in terms of their fiscal policy. They've announced 500 billion of capital being invested in the next several years. That's a significant contribution to GDP. And so we see a renaissance of Europe at the higher level with some positive trends that will help our asset class, our private capital. So we can play a role deploying capital in partnership with founders, entrepreneurs, governments. We've done a lot of that through our infrastructure and private equity businesses, and that can clearly help Europe regain competitiveness in a number of areas.
So Tara, weigh in here, because you, of course, have a specialty in infrastructure as well when it comes to kind of a bit of a division of responsibilities. He mentioned there that massive fiscal spend from Germany. I imagine you're in conversations with some of the leaders of Europe. There is a question, though, of how long that lasts, how quickly that kind of infrastructure spend can come to fruition. What is your view on that at a time when not just KKR, but private equity in general is flocking to the infrastructure deals?
Yeah, so it's actually quite interesting, because if you think about half the world going to election last year, actually what we're seeing is political cycles are actually much shorter than the duration of our capital. And in the infrastructure space, you actually have to be very patient. But I think, it's good news about the $500 billion spend in Germany. And governments are actively talking to us more than ever. And if you think about this cycle relative to the global financial crisis, in the global financial crisis, debt sat with the consumer. In this cycle, actually, debt sits with governments. And so governments more than ever need to partner with private capital to help deliver their infrastructure solutions.
Yeah, Tara, so I imagine there's a lot of open doors when you're going through with money to spend, and governments are finding their hands are tied, and they're looking for co-investments and other people to play a role. We were talking earlier to an investor who was talking about the big appetite that investors have for putting money to work in private markets and talking about infrastructure. But he was careful to divide it up into different types and say, maybe some areas of infrastructure, there are just too many people who just think everything's wonderful, like data centres, for example. And maybe on the other side, he was saying they're focused more on ports, bridges, roads, that sort of thing. Where are the biggest opportunities in infrastructure?
So I've been investing in infrastructure for the past 25 years, and the tailwinds couldn't be stronger. And two key areas where those tailwinds are really strong are energy security and digitisation. And to your point on digitisation, I think, if you look at the spend that's required to 2028 in fibre, towers, data centres, it's $3 trillion of capex globally. So that is a multi-generation kind of trend that, we can invest behind as infrastructure investors.
Mattia, we have been talking a lot about, doors open maybe to private equity money. Governments very happy to have conversations about where that money can be usefully put to work in Europe and elsewhere, no doubt. But there are other conversations that happen around private equity, and you guys have been bidding for a lot of UK assets, and other private equity businesses bidding for a lot of UK assets. And that leads to some people saying, what's wrong with the UK listed markets? Why can't they be more resilient in the face of foreign takeover, private equity approaches? Is that something we should worry about or not?
Well, as mentioned earlier, having private capital as an enabler of growth and economic development is a positive trend. By the way, what we do is not just taking companies private. We invest a lot in partnership deals. Europe has a lot of family-owned businesses, relative to other markets like the US. The breadth and the depth of family-owned businesses in Europe is significant, and a lot of these entrepreneurs often seek capital to take the company to the next level, to grow their businesses internationally, to buy other companies, consolidate fragmented markets, and that's where we come in, providing that capital and our operational capabilities and our global resources that enable those founders and entrepreneurs to expand their companies. This is not just valid in the UK. Across Europe, we see that trend continuing, and we do support the European renaissance through our capital in a lot of what we do.
What does Europe need to do to be better at this? What do we need to do in Europe to get better at attracting money to invest in our kits, our infrastructure, our markets? You talk about the Draghi report. Does it go far enough? If you guys look at the barriers that you face right now here, what are the most significant ones, and what do you think the easiest ones are to overcome?
Look, I think investing at the end of the day is about people. So, and Europe, unlike the US, is very nuanced with lots of different jurisdictions, lots of different cultures. So you really do need to be local in the markets you operate to kind of navigate political landscapes, regulatory landscapes.
But the idea is that Europe's meant to provide some degree of commonality. That's the idea of a single market. That's the idea of single regulation. That's what Draghi's talking about. You talk about the fact that there's lots of different jurisdictions. The idea is we want to get rid of some of that. So how big an impediment is that, say, versus investing in the United States currently?
So I think in Europe there is a higher regulatory kind of hurdle when investing, and I think investors are attuned to that. But that is the framework in which we're navigating on a day-to-day basis. I don't know whether Mattia had a...
I would add that the Draghi report points to a highly fragmented market in Europe across everything pretty much, and talks about consolidation at the corporate level, consolidation by sector, and also getting the European Union more integrated in taking decisions and actions, not as individual countries, but much more as an entity. So that's an opportunity for us, because a lot of what we do with our capital is to support businesses consolidate their sectors, either within countries or across Europe. And so, part of our opportunity set in Europe is really provide that capital for consolidation, for investment in digitization, in energy transition, in infrastructure, and a lot of the themes that we invest behind.
How much faith do you have that things are going to change?
We've been doing this now for almost 3 decades in Europe to really help businesses consolidate. We've done it more on a niche scale historically, and now with a call to action and some of the responses that the European countries are having, we feel that could be amplified even further. There's going to be much more of an acute effort to consolidate industries across Europe and leverage private capital to do that as well.
Well, talking about that private leverage, then, this is the perfect time to talk about the capital markets. 2025 was supposed to be the year of IPOs re-emerging, all these take privates to finally kind of get out of this deal glut. And that's not happening. And it feels like it's because of that volatility. But how does that square with maybe some of the other liquidation of assets you're seeing from endowments, but from other long duration asset holders? Are you worried about too much of a deal glut?
So look, when we step back and we look at and everybody talks about monetizations and how IPO markets affect monetizations in private markets. When we look back and I look at our history of monetizations, IPOs have been a very small part of our monetizations opportunities. Most of our exits have been to other financial investors and or strategic investors, corporates. And so we don't necessarily rely on IPOs and liquid markets too much as an industry and as KKR to monetize our investments. And so there is a hope that capital markets in Europe will consolidate at some point, the banking union, the capital markets union.
What's your timeline on that?
At some point.
At some point.
How long do we wait for that to happen?
I'm hopeful that with some of the calls to actions that we've talked about and some of the talks and reactions that governments are having, the U-turn in Germany, there's going to be a more concrete effort to make some changes at the European level to drive a more integrated capital markets and or banking market.
So what is that doing to valuations then? If you start to see, let's say, the capital markets on pause for a second. We had Lynn Martin talk to Bloomberg in the last 24 hours talking about that even for the New York Stock Exchange, the most liquid capital market in the world, they're not even looking at IPOs until the back half of next year, if not further along, in terms of really getting that fund flow going. What does that do to valuations when you're trying to scoop up new deals? Does that bring valuations down because people maybe don't want to be holding assets that long?
Well, we are long-term investors, and we think about the potential of the business to compound earnings over 5, 10 years, 15 years plus. And so the valuation question is really down to risk returns and how much you can change and improve a business from an earning standpoint.
Does it change sectorally, though, with an AI story, for example? Are AI private valuations following AI public valuations?
So absolutely. So every sector has its own earnings momentum or earnings power, and therefore attracts a different valuation. If you look at our portfolio in Europe in private equity over the last year, it grew earnings by 18%. And so our concept of valuation is obviously relative to the ability to continue driving growth in our portfolio. And over time, we've always solved for similar returns and similar risk returns We do not expect valuations to improve over our investment cycle. And so, yes, there is an opportunity to invest in certain assets at the moment because of the volatility at more attractive prices, but it's down to that risk-return equation that doesn't change significantly over time.
Now, it falls to me to ask about one particular investment that you're trying to make at the moment in the regulated water sector in the UK. And I don't know who's best positioned to comment on this. Maybe Tara, you have a go. I mean, we've been reporting a lot on what you're looking to do with the existing creditors in your attempts to buy this business. And maybe you're limited in what you can say about that. But I wonder what your approach is with the regulator, with Ofwat. What are conversations like with the regulator at this point?
It's an exceptionally complex situation. You've got the environmental agencies, you've got the lenders, you've got government, you've got Ofwat. So there's a broad range of stakeholders there. I think if I take a step back, KKR is a top 3 infrastructure investor. We own 8 regulated assets in very different markets under very different regulation. And we've actually controlled the UK water company before. So, this is a situation we understand, but ultimately, we're talking about the hypothetical here because the stakeholders will decide what to do with Thames Water.
The stakeholders will decide. And you think that there's a role for KKR, that this type of business can work under a KKR umbrella?
It's an infrastructure business of a similar nature to what we've actually owned before.
How does infrastructure investment change over the next few years? You've got underinvested spaces like Thames Water, which now need heavy investment. You've just had a huge outage in Spain and Portugal. Massive changes taking place in the way that big infrastructure grids are managed. You talk about how the stakeholders are going to be involved in this process. Is it becoming more complicated to navigate some of these spaces at the moment, given the need for change, the need for investments, new technology coming in, new priorities with the green agenda being emphasised as well? You talk about the fact you've run these kind of businesses before. Is running these businesses more complicated now than it was?
Look, I think with complexity in the market, there definitely comes opportunity. And I talked about energy transition and digitisation as themes. Now, they are actually interwoven now.
Sure.
With energy being required for data centre growth, for example. And so you can see those two themes merging together. But if you look at grid capacity and what's required there, they are actually quite simple investments.
Right.
And we just made an investment in the US with American Electric Power. Interestingly, that's a $54 billion market cap, but its capex profile is also $54 billion.
Okay.
And so this is where private capital can help at points in time where there's these large humps of capex to, help deliver what people need.
Globally, how much? Just give me a sense of the scale of what we're talking about globally. We're going through huge transitions at the moment in numbers of different spaces. Do we have enough? How do governments do it? How do you do it? Do you have enough? How much capital is there required out there to make these changes? And is it going to be capital constrained?
If we look at digital, it's $3 trillion in the next 3 years. So it is a capital-constrained space.
Yep.
And I think that evolution means that it will take longer than what people expect.
OK. That's where I thought we might be.
Tara, Mattia, I'm going to give you the final word on this. What do you need to continue to be bullish on Europe? Tara, I'll start with you. From the regulators, from the likes of Emmanuel Macron, Friedrich, Merz, et cetera, what do you need to get really going in Europe?
I think when we think about what makes our business really important, it's teams on the ground and people with aspiration wanting to do good things.
What about you, Mattia? If you had a wish list for the regulators, for the European leaders, a magic wand, what would you ask for?
Well, I think we've got a lot of the ingredients we need to be successful in Europe. We've seen our momentum increasing significantly. If you think about the volatility of this year, we've invested $30 billion globally, a lot of that outside of the U.S. We've committed since Liberation Day $10 billion in Europe specifically. And so we see the momentum being very strong, and we think these are the prerequisites for us to be successful over the next 5-10 years.
You don't need anything from the government? You're all set?
We are pretty positive that the governments are doing the right things to make us successful in Europe.
Fair enough. Co-heads of KKR, EMEA, Tara Davies and Mattia Caprioli, joining us around the table to talk about just how the private equity market is faring in Europe.
Yeah, and talking about that data center story, we're going to focus on it next. We're going to be talking about what we're going to see in Nvidia's numbers coming out a little bit later today after the bell in the United States. What are they going to say about AI demand, data center demand? We're going to get the details of that story next. This is Bloomberg. Welcome back. It's Wednesday the 28th. Just had to check. We are, 50 minutes into the equity market session thus far. Equities look like this. We're a little higher than when we first started out this morning, first thing. So we're up by, let's call it 0.2, 0.3 of 1% in Europe. US futures have been sort of gently rolling over. They're not down by much. I don't think there's a lot to see there in terms of the narrative. Bond markets a little on offer this morning, so yields are going higher. Apparently, we're all supposed to be paying attention to a Japanese 40-year. Never talked about the Japanese 40-year before, but now it's the story that we should all be focusing on.
Absolutely it is. And Guy keeps trying to write off May. There are still days of May. It's May all this week. I'll just point that out for Guy so he doesn't get confused.
Monday is the first.
There we go.
I know
Monday
that.
You can move on. We can all be in June by then. Let's have a look at what's lies ahead for us when it comes to the events on the calendar. OPEC Plus ministers at OPEC Plus are holding a virtual meeting today, so that could be interesting. We're watching for what decisions that grouping is going to make in the near term around production. Will we see a 411,000 barrel increase? President Zelenskiy is going to be in Berlin. We talked earlier on in the programme, and we'll get to that in a moment. We also get FOMC minutes, lest we forget about that. And we have Nvidia numbers out later on today. Let's turn to that topic, shall we? When it comes to equity markets, the next big catalyst, could it be the numbers out of Nvidia? First quarter earnings report coming through after the US bell. So we've got to go all the way through a US session, which looks flat to negative before we get there. Now, the last of the Magnificent Seven companies to report, really the final word on whether the stock markets had a good quarter or not. And what could set the tone for Wall Street heading into June? Joining us now, Matt Bloxham, who leads our tech coverage in London for Bloomberg Intelligence and is on set with us right now. Matt, talk us through your thoughts. Is Nvidia weathering the storm?
Yeah, I think they are. I think obviously it's had a bit of a wobble for a couple of quarters, but demand from the hyperscalers is robust. They had some supply issues with the Blackwell chips, which is the next generation of chips, but a lot of those have been resolved now, and the market's looking for them to kind of ramp supply of that, and they can't make enough of them for the US hyperscalers. So I think, generally speaking, people are looking for encouraging signs, both for the quarter that's just finished and also for the next quarter or two ahead. Obviously, there are worries about the indirect effects of tariffs on the company, whether that's going to kind of crimp demand a bit, but I think there's enough structural demand coming for the next year or two that they should be able to sell through that. Obviously, China is a big focus. They took a $5.5 billion write-down because of the latest constraints on the H20 chips. They basically can't sell into China. Our estimates are that could cost them about $15 billion of revenue for fiscal 26, which is about 7 or 8% of total sales. So it's not insignificant, but I think that the ramp in Blackwell demand will counter that.
What matters more, the trade war with China, those export controls, or the AI momentum?
I think the AI momentum, for sure. I think most analysts would think that over time, a bit like we've seen with Apple, China's going to fade in terms of significance because they have their own China-centric AI agenda. So I think it's really the kind of ex-China AI demand that's more important, and that's where all this kind of story about Middle East demand and sovereign AI infrastructure could be really important for them. Talk of the UAE buying 500,000 Nvidia chips a year, which could be $10 to $15 billion of annual revenue, which again, kind of up in that kind of 7-8% of sales. So kind of helpful growth if the hyperscaler demand starts to tail off. You've got that second structural tailwind coming through.
Average for the year, 125. What are we trading? 135 now. Low, 94. We're above the average. Does that mean the glass is half full? Are we looking for good news rather than bad news? We'll find out a little bit later. Matt, thank you very much indeed. Matt Bloxham joining us from Bloomberg Intelligence. And do not miss Bloomberg Technology special coverage of those Nvidia earnings. We're going to get live reaction to the figures from the CEO. Jensen Huang is going to be joining us a little bit later on. We are obviously going to be hearing him speak as well to investors and analysts. All of this coming up at 11:30 p.m. UK time. What else do we need to know this morning? Let's talk about what is happening in Berlin today. Bloomberg has learnt that Ukrainian President Volodymyr Zelenskiy is set to travel to the German capital for talks with Friedrich Merz today. This obviously follows news about long-range missiles that has come over the last couple of days. Bloomberg's Ollie Crook joins us from the German capital. Ollie, we are hearing growing criticism from the White House of Moscow's actions. There is talk of sanctions, but the question we're now wondering is, does it turn into military hardware? How does what happens today in Berlin alter, influence what is going on with the resupply of Ukraine? Put it all together for me.
Yeah, well, I think that Zelensky will come here to try to find out, in some sense, what kind of ally he has in Friedrich Merz, who has been a much more sort of hawkish voice in terms of supporting Ukraine than his predecessor, Olaf Scholz. Olaf Scholz, who also was a very strong defender of Ukraine, but was very sort of reticent about sending long-range missiles, giving permission, sending tanks, was always a step behind the Americans, basically waiting for Biden to do something and then coming into the fold. Friedrich Merz has really cast himself as somebody who's going to be much more active, much more proactive in terms of supporting Ukraine with these Taurus missiles. There has been a bit of controversy over that over the last couple of days. He was sort of making some very ambiguous statements, not clear whether or not Germany will actually deliver those missiles to the Ukrainians, whether or not, and these are missiles, by the way, that were so sort of fraught as a military issue because they can strike basically Moscow, theoretically, from within Ukraine, which is why Olaf Scholz didn't want to deliver them. So today what we will find out is what kind of ally Friedrich Merz is going to be for Zelensky at a moment when, as we know, the U.S. administration is stepping back ahead of this summer potential offensive by the Russians. We have Russian troops that are amassing more and more on the Ukrainian border. And at the end of the day, there needs to be an anchor that holds down the foundation of support for Ukraine. In the absence of the United States, will that be Germany? And, Friedrich Merz really wants to turn Germany into a military sort of powerhouse. Yep. And that is going to be the conversation that is held between Zelensky and Merz today.
We'll look forward to the coverage a little bit later on. Bloomberg's Ollie Crook joining us in Berlin. That wraps things up.
It does.
We work our way through into... I think it's going to be an interesting session. I have a sort of... I'm wanting...
Your spidey senses are tingling?
Well, no, I'm just... I think there are interesting things that people can't quite figure out what's going on, and that always kind of... You either sit there and you wait...
Yeah.
But are we going to see a catalyst? The FOMC minutes, I think, could be worth paying attention to. There's various things coming up. Anyway, the Pulse is next. This is Bloomberg.